founders and talk a little bit about why we're doing this as well as how. We actually talked last week a bit about why the fund works, why we actually decided to do this. Talked about how we really needed something to help get capital to a bunch of companies from around the world and to actually solve a number of the problems that we actually saw in the venture capital space, and how do we actually get capital to emerging markets where there isn't any liquidity. I wanted to talk a little bit about this week about how the actual mechanics of the fund work, and feel free to answer any questions that people might actually have during this fund. And so how? A lot of times, I'm going to preface it a little bit about sometimes people get a little bit confused if they're coming from a traditional venture capital space. We are structured different than a traditional venture capital fund, and we are actually solving some of the problems that we actually find inside of those venture capital funds. I'm going to talk a little bit about performance and why we're actually doing that. Two of the key studies that we actually used when we're designing this fund, and as we've been thinking about venture capital performance in general, are two studies by the Kauffman Foundation. One is a study called "We Have Met the Enemy and He Is Us." The second one is the returns of angels investing in groups. And so the returns of angels investing in groups was actually quite interesting to us. What it showed was that when an angel investor, or say a rich person, invests their own money into entrepreneurs, and if they can actually build a portfolio of 20 to 25 companies, they tend to do about 20 to 25% year over year. Starting year 3 or 4, they'll actually start to see returns from that portfolio. And so as an asset class, entrepreneurs are actually a quite good asset class. And this isn't just in Silicon Valley. This was 3,000 investments across multiple continents. It was in the United Kingdom, Europe, the United States. And it was actually really, really encouraging to us when we actually read that. There's a second study that they actually did, which was a retrospective study of the Kauffman Foundation. They are a $2 billion foundation, and they are dedicated to the study of entrepreneurship. When they actually, so the Kauffman Foundation studied how their performance was when they actually invested in venture capital funds. And what they found was actually pretty distressing to them. They found that when they invested in venture capital funds, and they did a retrospective of over 30 or 40 years, they found that their financial performance was about 5 or 6% per year, which was kind of mind-blowing, because you would think that venture capitalists, being professionals in the industry, would do more than 5 or 6% per year. In fact, the Kauffman Foundations found that they would actually be much better off investing their own capital in index funds, just straight index funds with low management fees that would just track how the stock markets were actually doing. And so when we actually looked at that, we noticed that there's essentially a 20% difference when angel investors invest their own money and when venture capitalists invest other people's money. The venture capitalists do 5%, angels do 25%. Why is that? It actually goes to how venture capital funds are structured. A venture capital fund tends to charge a 2% management fee every year, and these tend to be 10-year funds, i.e., they promise that the investors, this fund is going to last for 10 years. They'll charge a management fee for the first 5 to 10 years. And then after that, the fund should be done, and then they'll actually have returns. But if you charge a 2% fee per year, that sounds quite reasonable, but over a 10-year fund, that can be upwards of 20%, which is actually quite high. And so when we first started looking at this, we saw that angel investors do 25% per year on average. venture capital funds do 5% per year on average. What's the delta? That's a 20% difference. And so we think that that actually comes from management fees. And in fact, the Kauffman Foundation did some correlation studies, and they actually found that high management fees actually just decreased fund performance for themselves. So what we've actually decided to do is we've decided to tackle two of the hard problems in venture capital. One, the first and foremost, is liquidity, that people cannot make money unless the startups in the portfolio actually exit. They have a merger and acquisition, or they have an IPO. The second one that we've actually tackled is the management fee piece, and we'll talk with that in a little bit. So I just want you to keep that in mind as we're actually going. The actual structure of the hack fund is going to be very similar to like an ETF or like a mutual fund, as opposed to a venture fund, so that we can actually solve some of those problems. So I'm going to simplify it, and I'm going to give some random numbers just to be able to talk about it. Let's say our fund, we're selling hack at $1 a piece. Let's say we have 100 million shares that we actually sell initially. Each share would be sold at $1, and for every dollar, someone would get one hack token. We're calling them tokens. You can think of them like a digital stock certificate or like a share. We do think that this is a security. We are being SEC compliant with this. We're very compliant with the Know Your Customer KYC as well as AML rules. We'll talk about that as well. So let's say we actually sell one of these shares for $1 a piece. And let's say we raise $100 million through that. The way the token is actually set up is hackers and founders will get an additional 20% on top of whatever it is that we actually sell. So if we sell $100 million worth or 100 million shares, hackers and founders will get 20 million shares. If we sell 10 million shares at $1 a piece, hackers and founders will end up getting 2 million shares. We are locked in to being able to sell those tokens. We cannot sell those tokens for 4 years. So we have to actually make sure that these tokens increase in value over 4 years. Otherwise, we don't win and we don't make any money. So that's the first. The second is in a normal venture capital fund, when a startup exits or gets acquired, that money goes to the limited partners or the people who have invested in the fund. That's called, and they end up getting, the people who manage the fund get a 20%, what they call a carried interest or profit sharing. And the investors would get 80% of the profits. The fund managers would get 20% of the profits. How our fund works is very different than that. We are going to get, for instance, in the $100 million instance, we get $100 million into the fund. We would actually invest $100 million if buying stock in individual companies. If one of our companies exits, that money goes back into the fund and gets reinvested into the next generation of startups. And so the value of the fund will actually end up increasing because it will actually have more assets. Let me give an example. Let's say we take $100 million and we invest into 100 companies, and we own 10% of 100 companies, for instance. If those companies are growing in value, we own 10% of one of those companies. One of those companies exits for $1 billion, and 10% of that goes back into the hack fund. That would be $100 million would go back into the hack fund. That would actually get reinvested into another generation of startups, but we would still also own 10% of 99 companies as well. And so the fund is designed to be evergreen, so it will actually keep growing and growing and growing over time, as opposed to the companies actually leaving, exiting, having what they call a liquidity event, and then that money actually leaving the fund and flowing out. So our token is actually designed to grow in value over time based on the exits. The second mechanic that we're actually doing that's quite a bit different than an actual venture fund is obviously our token is going to be traded on exchanges. So how are we going to actually show what the value of our portfolio is? We have a partnership with eShares, or if another company comes along that actually has a better product, we can certainly evaluate them. But eShares actually has a product where you can essentially value a technology company for $250 per year. You plug in numbers and it will essentially compare this technology company based on comparables such as like publicly traded stocks on international exchanges. It will compare the value of the company to other startups that are actually in its database. And it will actually give you a value of a company based on revenue, users, a certain number of metrics. And we can actually, will be able to kind of take the eShares rubric for actually scoring these startups and for actually valuing these startups, and we'll actually publish it. And so we will actually get valuations of our companies a couple of times a year. We will aggregate them. Let's say we own 10% of 100,000 companies. Each company, let's say we own 10% of 100 companies, and those 100 companies in aggregate are worth $10 million. We own 10% of 100 companies that are worth $10 million a piece on average. We would have $100 million worth of stock. Does that make sense? And so as these companies are growing, then we would actually report the value that is actually growing of these companies. And so a hack token represents, there's 100 million tokens that are actually issued. It will represent 1/100 millionth of the portfolio of the assets, which would be startup stock that this fund actually owns. And we will report the value of these companies as they grow. If, for instance, a company improves revenues or grows revenues and profits by 30 or 50% a year, across the board, if in our example, 100 companies on average grow their profits 30%, 50% a year, then the value of the portfolio should grow 30 to 50% year over year. And we will announce that. We will actually have those valuations, those aggregate valuations audited. eShares makes that very easy for us to do. We will have that audited, and then we will actually report that. My goal is to eventually be able to put that report on a blockchain so that it's actually out there and people can actually see that it's been audited, that it hasn't been changed, and on a periodic, and then the market can actually decide what the value of our token is. We do reserve, people have asked the question several times, is what if the price on the market per share is lower than the net asset value of what it is that we actually own in the portfolio? Hackers and founders, as managers of the fund, we actually reserve the right to actually buy back tokens from the fund if we actually think it's necessary. What do I mean? Let's say if there are $100 million worth of assets in this fund, and the tokens are selling, we have 100 million tokens, they should be selling at $1 a piece. For whatever reason, they're selling at 70 cents a piece, i.e. the value of the fund is less than the value of the net asset value of the fund. In our mind, that's an excellent buying opportunity, and so we actually reserve the right to purchase our own tokens, which should increase the price of that so that the price can essentially match the net asset value of the fund. So why? Because we actually see growth in the value of the fund. Long term, if we actually have more, assets, more cash, or more liquid cash in the fund than we know what to do with, we can also buy back stock in the fund. And so the idea of this fund is very much more like an ETF or like a mutual fund, where you put money in, and then the value of these assets grows over time. And then people can essentially buy, sell, and trade these shares on online exchanges based on the growth of that net asset value of the fund. It's a very different concept than a venture model where you put money in, you bury it in these companies for a decade or more, and then you only get it back out if those companies are sold. In this model, you're buying pieces of 100 different companies. You're measuring these companies' growth. And as these companies grow, the market will actually decide what the value of those companies are. We are also reporting and measuring the growth of these companies. So that's kind of the core mechanic, which we feel actually fixes a huge problem in venture capital in most of the world. That liquidity piece, we think, is actually incredibly, incredibly important. Why? In vast majorities of the world, there is no liquidity, i.e. companies just don't get bought and sold. We talked last week about how 85% of the world's technology mergers and acquisitions happen in Silicon Valley. And so that is the core reason why so much money flows into startups in Silicon Valley, is because investors can make money and they can get money back out of those startups. A liquid fund, which is why we're tokenizing this fund, which is why we're actually building it on a blockchain stock certificate and letting that price of that token or that share essentially trade on exchanges. That is one of the core mechanics that we're actually doing. I wanted to talk a little bit about the second mechanic that we're actually using in this, which is actually management fees. It is quite a bit different than a traditional venture fund. And I made a reference at the very beginning into the difference of when angels invest into an asset class. When angels invest into entrepreneurs and buy startups, they tend to do 20 to 25% per year. And when venture funds actually do 20 to 25% per year, and the difference between those two tends to be a management fee. 2% management fee a year for 10 years will be 20% of the capital that you actually would take off the table. So what we're doing in our fund is we are taking a specific percentage initially off the table to actually be able to repay tokens to our advisors. I believe the number is going to be 8%. And out of the rest of that, 69% is actually going to be invested into portfolio companies. 8% of that will actually go to tokens, will actually go to advisors, as well as to actually repay the costs of the ICO. These things actually tend to be fairly expensive to actually launch. And we are reserving 2% of the fund to actually be able to distribute tokens to the entrepreneurs in our portfolio. We actually want our founders to be co-investors along with this into the venture fund. And 2% of the fund we are actually reserving to go to our community, i.e. Hackers and Founders has a bunch of people organizing community, creating startup events around the globe, and we need a way to be able to connect our for-profit business to the value that all of these people are actually creating around the globe, and so reserving 2% of our fund for that. The last bit that we're actually saying is that how do we actually pay our bills while we're doing this? We are committing to repay money that we use for our operations at 5% interest, and that will come out of our profits. What does that look like? So we are going to have 19% of the fund. When it's all said and done, I believe the white paper says 20%. We're going to lower that a little bit right now to 19%. We're still in the process of that, so bear with us. But we are going to keep 90% of that. We cannot sell our tokens for 4 years. i.e. we cannot get out, we cannot profit, we cannot pump and dump this thing for 4 years at least. I have no interest in pumping and dumping this thing because I want our portfolio to grow as much as possible, as quickly as possible. But at the same time, we actually want to guarantee and tell our portfolio holders, our owners, our investors, that we are actually going to be in this for the long term. When we actually do sell our tokens, anything that we have used, capital that we have used for operations, we will actually repay out of our first sale of our tokens at 5% interest. So let's say we end up using $1 million a year for 4 years. Our first token sale at the end of 4 years, when that vesting period actually completes and those tokens are actually released, we would have to actually, the first $4 million, we would actually have to repay at 5% interest over 4 years. So we would actually have to repay that, the whatever $1 million we would actually have to repay before we actually receive any cash or any fiat from those tokens. And why is that? Why would he actually want to repay, if we're doing the work to actually operate a fund, why would we want to repay a management fee, essentially our operations budget at 5% interest? One is because we're actually pretty ridiculously obsessed with running a cost-efficient operation and running, not having management fees. When I invest personally, I like to invest in things called index funds in the public stock markets, which have very, very low management fees. And if you actually look at the data across the stock industry, all things being equal, in hedge funds, private equity funds, what have you, the funds with the lowest management fees tend to perform the best, which is why we're actually pretty obsessed with this no management fee thing. It also actually, interestingly enough, we actually make more money over the long term this way. What do I mean? Let's say we took a venture fund. Let's say we raised a $100 million venture fund, and we charged the venture fund 2% per year as a management fee. Out of the $100 million that our investors put into this fund, $20 million essentially would come off and go into our pockets. We would get the $2 million a year out of that venture fund, and that would essentially be our management fee. That would be our salary. That would be what we actually make as a living for this venture fund. And so it would only be $80 million that actually got invested into the startups. And let's say that grows over the long term at 5 or 6% interest per year. You're going to end up with, $80 million times 5% interest per year times 10 years is going to be whatever. In our model, if we actually end up borrowing, $1 million or $2 million a year out of the venture fund, our investors, if they put $100 million to work, $100 million actually grows in value. If we do $2 million a year for the first 4 or 5 years, we use $10 million. After that, I don't want to keep borrowing money. I would actually rather repay what I've borrowed at 5% interest. So let me actually repay that. So we put $90 million to work in the same model. We would actually, the entire fund, the entire $100 million would actually grow in value, would actually grow in value. All of that money actually gets put to work. Now, our track record over the last 5 years is we have been doing 30% per year. If we were angel investors, we would be doing 20 to 25% per year. Okay, so if you can actually do 20% per year, and you can actually borrow money at 5% per year, you actually want to put as much of that money to work as possible. You want to put the entire $90 million to work, making 20% per year or 25% per year, and then you want to repay that at 5% per year. If you actually do a spreadsheet and actually map it out, how the venture capital model actually works compared to this model, over the long term, we actually make more money and our investors make more money doing it this way with our repaying our own management fees. So the structure of the fund is built in with this core idea that we have to add value over the long term, otherwise we don't make money, as well as we, our investors, understand that those are our economics and that we actually make money over the long term. We have had a couple of questions in the Telegram channel about how are we going to actually know how much you guys pay yourself, how much you guys are using. We are actually committing to submitting financials on a yearly basis and actually letting that be audited by a CPA. And we will be posting that as well with our valuations. I drive a Nissan. I rent a house in Silicon Valley. I pay $2,000 a month for rent. If anybody's actually met me, they know that I don't really live an extravagant lifestyle. If you actually talk with our team, they actually know that all of us are kind of operating on a startup budget. We are committed to essentially being good stewards, wise users of our investors' money. Why? Because we want to make more money over the long term, because we want to have more impact, and because frankly, it's in our best interest to actually do this over the long term. And so those are the two kind of key mechanics that we actually are using that are very different than a traditional venture fund. Other questions, we're going to talk now about how we actually select our companies. We have actually been doing this for 5 years, or a process very, very similar to this for 5 years. What we've been doing for 5 years is we will actually get referrals, or people, startups will actually talk with us. In our Silicon Valley office, in our Mexico office, the process works the same way. People actually talk with us. We will actually find startups. We interact with startups from around the globe because of our events, because of our huge, massive network of people who've actually been running startup events. And so we see tons and tons of startups. They actually apply online. Right now, you can apply through AngelList. We are building software to actually make that application simpler and a bit more tailored to what it is that we do. People answer a series of questions. It has been 5. We're probably going to increase that to about 20 questions. But people answer questions, and then the first pass review that we actually do is, did you fill out the entire application? Did you follow the instructions? Did you just do what we suggested that you do to actually do this? If it's a half-assed application and you haven't filled everything out, then we'll just let you know, hey, we can't really evaluate this. Step 2 is we actually do what we call a peer review process. So we have entrepreneurs, both from our portfolio and from our community, review and score every application. And we do this in a name-blind, gender-blind way. What do I mean by that? Our applications, we remove people's names, we remove people's genders, we remove people's ages, references to what schools they went to, and we name, gender, schools they went to, and race. And so the application is just on what the startup and the people have actually done, not necessarily on where they have come from or who they were actually, what families they were born to, or what race or gender they are. And so we have a blind selection process. Why is that? Just because if you actually look at the best data, it actually shows that you get better results when you actually just look at people's performance, as well as you actually try to remove as many biases and prejudices that you actually have. There have been studies that show, for instance, that funded startups that have more women founders actually tend to perform better financially. Unfortunately, in Silicon Valley, less than 4% of startups are actually funded by that are funded are actually have women founders. Less than 1% of companies have an African American or a Hispanic founder in Silicon Valley. So we are actually trying to solve that inequality problem by just saying, look, let's put everybody on the same playing field. Let's try to remove people's, make this as bias-free as possible. Let's just look on what does the company look like on paper? What have they done? What have they accomplished? Let's have entrepreneurs review and score that. Everybody who applies gets a written score. They also get the average scores of the entrepreneurs that review them. They also get comments written. And so everybody who applies gets a score and written feedback. We use those scores internally to see if the startup should actually go on to the next step. If they actually go on to the next step would be what we call investor office hours. So they will actually meet with 3 to 5 of the people who've actually invested with us before. Or other investors that we have close partnerships with, investors who have actually invested in our portfolio companies. And so the investors then have a Zoom interview or a video interview, much like we're doing now, and they have a chat and they review and score those chats. The chats are about 30 minutes. We usually score them. They come from, our investors are around the world, our entrepreneurs from around the world. So we actually tend to schedule this so people can actually have this video chat for 30 minutes. And then at the end of those 30 minutes, conversation will finish. We will actually ask the investors to score the startups, and then the startups actually receive the scores and the comments from the investors when it's all said and done. And then we actually look at those scores and comments that the investors used, that the entrepreneurs gave the startups. And if the scores are high enough, we will actually sit down with the startup and we will talk about what it is they want to accomplish, what it is that they actually want to do, what it is that they feel that they need, and we will find out if we feel like we're actually a good fit for helping them get to where it is that they actually want to go. If you have a photo sharing app and you want to share cat pictures with your college friends, frankly, I don't really care. I've done a cat picture startup before and I'm kind of burnt out on them, and I'm not going to be very engaged with you or your startup, and my team probably won't be that excited about it. And so it's probably just not a good fit. If you have a product and you are making revenue, if you are actually selling things, if you are making life better for your customers, and if you are solving a significant problem in the world, that's actually a lot more interesting to us, and we're actually much more likely to engage. The investors score the startups on, basically we ask them for 2 things. One is, how likely do we think that they will be to actually raise $500,000 in Silicon Valley? Or how likely are they to do $250,000 in revenue in the next year? That's in Silicon Valley. In Mexico, the numbers are a little bit lower just because the economy is smaller. I don't have those numbers in front of me right now. I apologize. If anybody wants them, we'll actually provide them. But the idea is, how likely is this company to actually raise money from other investors? Should they raise money from other investors? And how likely are they to actually do revenue and to hit revenue metrics and milestones and sales? We tend to lean very, very heavily towards companies that actually have a product, that are actually selling that product already, that actually see some uptake in the market. We tend not to work with companies at an idea-only stage. Every now and then, we might actually do one in our portfolio if it's an idea that we really, really believe in, if it's a problem, and if we know that there are actually customers that really, really want this problem. We tend to be very customer focused as well. Who is the company's customer? How many of those customers are there in the world? Is it a large market? We do not need to have companies promise us that they will be a unicorn. We do not need our companies to promise us that they will actually sell their company over the long term. Why? Because the core metric that we actually use is this company growing? Are they growing revenues? Are they growing profits? Are they actually scaling? And we have to measure that, and we have to report that to you, our investors. And so the core metrics that we actually focus on is this a company that's growing, and will it grow quickly? And those are the metrics that we actually use and we care about to actually select our startups. And then when we actually work with the company, we actually engage long-term with the company. The process would be, we would sign a term sheet, we would go ahead and make the investment, do the legal paperwork actually required for that. The next step is we do what we call a deep dive. We actually sit down with the entrepreneurs over several hours. We get to know the legal structure, the financial structure, the company, the legal agreements that you have between the founders. Do you guys have a vesting schedule? We get you set up with a good bank. We get you set up with a good lawyer to make sure that things are actually there. We work with a lot of companies from around the world. And so if these companies are actually prepping themselves to actually raise further rounds of capital, we actually want to be sure that you are structured legally so that you're ready to actually receive those further rounds of capital. So we actively work with the companies in that process. We look at the technology stack. We are hackers and founders, so I'm a software engineer. We do tend to kind of look at this. We have some very, very impressive technology advisors in our community and that are advisors to our portfolio. And then we look at the business model. How are you actually making money? Who's your customer? How are we going to actually get there? So we do what we call a deep dive internally. We have a checklist that we actually go through. We make sure that these kind of points, I's are dotted and T's are crossed. And then we start to actually work with the company over the long term. Get them in front of the lawyers, the lawyers, the bankers, what have you, that they actually need. And then we actually work a lot with our portfolio companies in terms of how do we actually help you grow sales? How do we help you actually grow revenue? I frankly would much rather have a portfolio company hit $1 million, $10 million worth of revenue than me helping them raise $1 million or $10 million from venture capitalists. Why? Because revenue is revenue, and raising money is you selling stock. And we both own stock in the company, and we want to be sure that that stock has the most value as possible. So let's grow the value of that stock by making your company more valuable, by having more customers, by having more revenue, by building better technologies, and let's actually get you there. So we tend to think very kind of long-term with our portfolio companies. We think we're a bit unusual in Silicon Valley in that we actually think of things like sustainability. I love profitable companies. I like a company that has the ability to kind of flip the profit switch on. Capital exists to actually grow a company. It exists as kind of rocket fuel to be able to accelerate the company. And at that point, when you actually have really good metrics, when it costs you $1, when a customer costs you $1 and that customer pays you $3, that's called really good unit economics. When your cost of customer acquisition is $1 and the lifetime value of a company is $3, that's great unit economics. At that point, you just pour money into this machine. Every dollar that you put in generates $3. At that point, you have what we call in the industry a money-shitting machine. And at that point, it's time to actually raise a lot more money and scale this company. We also tend to do things that are also a little bit unusual. In our existing portfolio, we have worked with 55 companies. A third of our companies have actually lost co-founders. The co-founding teams have actually split up. When that happens, what we've noticed is that the founding teams tend to kind of grind to a halt. The lawyers get involved, people start drinking, they get depressed. Nothing really happens in the company for 9 or 12 months. So we actually do co-founder counseling. I call that a divorce. You get the lawyers involved, you break up, you're drinking, you're depressed, nothing happens, that's a divorce. So let's actually try to prevent divorces between co-founders, and let's actually do co-founder counseling to actually help them stick together and work things out. We do, we do communications kind of stuff, active listening kind of stuff. A large part of building a company is really the biggest challenges of building a company, in my mind. tend to be emotional. They tend to be social. They tend to be kind of dealing with the ups and downs of startup life. Oh my gosh, we had closed a deal. Oh crap, the deal fell apart. Oh, this is terrible. Oh my gosh, what are we going to do? Holy crap, we closed another deal. So how do you actually deal with those emotional ups and downs? We tend to focus a lot on those. We tend to talk a lot about those. We tend to talk a lot about what sucks, what problems you're having. We tend to be very problem focused. And, my personal background was I was in clinical healthcare for 20 years. I walked into patients' rooms and I asked them what hurts. Turns out when you ask someone what hurts, that actually is a good pathway to find out what actual disease is going on, and you try to drill down to what is causing that pain, and then when you solve that, the patient gets better. I believe that if you can actually talk about what sucks in terms of a company, if you can actually talk about what problems the founders are actually having, what their biggest challenges are, then you actually sometimes get down into what is the core root problem of what's causing this company to not grow. What are the obstacles? And let's find people who can actually remove those obstacles, or let's just remove them for you. And so we kind of take a role of a general practitioner. And we make a lot of referrals to specialists. We have a huge panel of official and unofficial advisors from around the world, amazing technologists, amazing people on growth, people who have, sold hundreds of millions, helped companies grow sales to hundreds of millions of dollars. And let's actually put you in front of the right people so that they can actually advise you, they can coach you, you can actually go. We also have, for instance, a service where we can actually hire people. We tend to find key players for our companies. We tend to actually, help them hire engineers. We're hackers and founders. We can actually do that. We help them build remote teams. We help them, find teams around the globe. I'm not a huge fan of building your entire team in Silicon Valley. Most venture capital funds want the entire team here. They want everybody to get paid, $150,000, $200,000 a year salaries in your startup. Why? Because the venture capitalists want to write you larger and larger and larger checks. And they want the team to work as fast as possible and grow as fast as possible. And they died. Oh, well. Our model, we actually want the companies to be profitable. We actually want them to grow revenue. We want them to try to keep costs down. We want them to have their employees happy. Yes, we want them to be paid a great salary. Yes, we want the employees to be sustainable over the long term. We want the employees, everybody in our companies, to actually get wealthy. We work very hard to do that, but we don't, grow, live fast, die young kind of model. We tend to actually take a bit more measured approach with our portfolio companies. At least that's our preference. Then we like revenue producing companies. We talked about the selection process. We talked about the support process. And liquidity options. What types of companies do we actually invest in? I'm a firm believer that a lack of liquidity is one of the biggest problems in private and startup business right now around the globe. So what we're actually focusing on, and the product that we actually want to evolve, is we want all of our companies to essentially have token-based stock. Digital stock certificates using blockchain tokens. Let's actually invest in our companies. Let's get them the capital that they actually need to grow revenue. And then let's actually take them, rather than, investing $20 million into this company, let's help them go to ICO and raise $10 to $20 million through an ICO and, trade their stock or trade their tokens on exchanges. I would much rather do that than necessarily have the money locked into that company for a decade. It just gives you a lot more flexibility as a founder, as a CEO, to actually have that type of capital available to you. You can also, when your tokens are traded more freely, there are also different options for you in terms of financing. Debt becomes a bit easier to acquire for these companies, because you end up being a bit more transparent. You're actually reporting. a bit more on your tokens. And so my goal isn't necessarily to IPO my companies. My goal isn't to get a company sold or acquired by Google. If that happens, great, fine. But at the same time, let's actually help these companies go to IPO, or excuse me, ICO, and let's actually tokenize their stock so that these companies can access global capital markets that are actually emerging in the crypto world. And so people have asked us, do we prefer pre-ICO companies or ICO companies? The argument would be, we want all of our companies to be pre-ICO, but we don't necessarily just want them to be a blockchain or utility token product. We very much believe in the power of blockchain and the power of these technologies. If it doesn't fit, it doesn't fit. But one of the low-hanging fruit in terms of blockchain technologies is just creating digital stock certificates. And so let's just make digital stock certificates, let's create securities, and then let's actually sell these securities using existing crowdfunding laws in the United States. Or if you're overseas, let's actually let's find a jurisdiction that will actually allow us to have these, that will allow us to crowdfund these, that will allow us actually to do these ICOs on a regular basis. And let's actually find exchanges that will actually be able to interact with these security tokens, or hell, let's just invest in an exchange and create bounties to actually create exchanges that can actually deal with security tokens from around the globe. So that is our vision of the future. We want a NASDAQ for securities tokens for these types of startups. And, that technology will actually be built on the blockchain. And so that is a question. Another question that's come up is, what ownership of the company will we actually target? We will target anything between 1 to 20% of a company in terms of the ownership. The check sizes that we will write, the sweet spot will be between $100K and $2 million, depending on how much we actually raise. Other questions, such as how many companies will we invest in? It's in the white paper. We're targeting about 30 companies for every $10 million raised. We're thinking about 80% of those will be seed investments, and about 20% of those will be larger investments like Series A type investments. Every company that we work with, we want to have access to our full portfolio services. Right now, we actually have 18 employees, 18 people in 3 different countries working full-time on Hackers and Founders. And so the goal is, how do we actually provide as many services, provide as high growth, high touch services to these companies as possible so they can actually be in the best shape forward moving forward. Because we only win if our entrepreneurs win and our investors win at the same time. So let's all actually invest together. The last bit that I wanted to talk about is the advantages of having a fund with 10,000 little small investors. One of the big challenges that technology companies have is, how do I actually get new users? How do I actually grow sales? Well, imagine being able to send out a tweet or a Telegram message to 10,000 mini investors and having them say, hey, can you guys retweet this? Having 10,000 retweets from your investors into a portfolio company is a huge value add. And so we actually want a large number of shareholders in this fund, and we think that that's going to be a huge benefit and a huge competitive advantage to any other venture fund that might have 5 uber wealthy investors. I want thousands of smaller investors who are interested in the success and growth of our portfolio companies. And so I want to, that's pretty much what I have in terms of the structure and the mechanics of the fund. I know we actually kind of got into some of the technical details there, but a number of people have actually asked about the technical details in the Telegram channel and the conversations that we've had. We do have a FAQ where a number of these answers or a number of these things are actually detailed in the FAQ. But I also wanted to open it up for additional questions if people had for a few minutes. At the bottom of the screen, right about here, if you move your mice down here, there's a thing called chat. If you actually click on the chat, you can actually pop up, the chat box pops up, and you can actually ask a question in there. If anybody actually has some, go ahead. There's also a button where you can Oh, I don't think you can raise your hand. There was in the previous version of this somewhere where you could actually raise your hand. But that's what we're actually doing. So we'll wait actually a couple minutes. If someone actually has a question, we can answer them. The question is, will token holders, Lorenzo asks, will token holders ever receive dividends? Dividends in tokenized funds are actually quite difficult, to do. So we're not planning on doing them. There, in the future, if the technology actually evolves where dividends are actually easier to do and we can actually build a smart contract where we can do that, yeah, of course, we'd be happy to consider that. We're actually very concerned in the growth and the value of the tokens. And so rather than dividend out money to the investors, what we'd actually rather do is to invest in more companies and to buy more assets, to purchase more stock in more companies so that the entire value of these things grows. We tend to think of venture capital, of this type of fund, much more like a Berkshire Hathaway. Warren Buffett ended up buying companies about 40 years ago, and he just kept on buying companies and buying companies and buying companies and buying pieces of companies. And his portfolio just ended up growing over the long term. I think a share is now worth like $130,000. And so that's the type of model that we're actually really passionate about, is how do we actually grow the value of the token over the long term. If we do have a lot of money in the bank or a lot of money just sitting in Ether and Bitcoin, we don't know what to do with it. We do reserve the right to actually repurchase tokens from our investors. And we do reserve the right to be able to burn those tokens if we actually think it's going to be in the best interests of our investors. So the idea is, how do we actually increase the value of this token over the long term as much as possible, rather than let's issue dividends and let's actually push out dividends. Most technology companies, until they get to be about the size of Apple, feel like they can usually grow money and you put that money to best use by actually growing it. Another question is, can we know the current value of our acquired tokens? When and how does the tokens change value, and can we sell them at any time? Yes. So after the initial token sale, after the ICO is over, we're targeting about June-ish or sooner if we actually close sooner. The tokens will be traded on online exchanges. We're talking with a couple right now. We haven't actually announced them yet. Chances are they will not be US-based exchanges because these are security tokens and we cannot have unaccredited US investors invest on them. So they will be global exchanges. And we do need to be sure that they can actually keep US unaccredited investors out, or that they do a reasonable job at doing that. But you would be able to essentially see the value of your tokens on any of these exchanges, and you could actually buy, sell, and trade them on any exchange whenever you wanted. Same way that if you actually want to buy Ethereum, if you want to buy some Litecoin, you can go onto an online exchange and you can buy, sell, and trade them. It'll be the same sort of idea. You'll be able to buy and sell hack whenever, and you'll be able to see the price of that hack as it floats, as it changes on a regular basis. That's kind of one of the key advantages, that why we're actually tokenizing this fund, so people can buy, sell, and trade them at any point in time. Are there any other questions that people actually might have? I can hang around for another couple of minutes, but that is pretty much what we actually had for today. I hope it was interesting. I know it was a bit of a technical discussion today, but a lot of people have actually had these technical questions, and hopefully this actually answered a number of them for you. So I'll be around for another 2 minutes, but that's pretty much our presentation. Thank you guys very, very much for your time. Thank you guys very, very much for your support. Please don't hesitate to reach out to us if you have any other questions or concerns. Torrance, can you put the links to our Telegram channel down below? And can you put links to the HackVC website if people have any other additional questions? We can do that. So thank you guys so much. Have a great day.